Welcome back to the deep dive. We know a lot of you have already done the really hard part. You've calculated that massive number for your life insurance need, but getting that total amount, that's really just the beginning. Okay, let's unpack this. Today, our mission is all strategy. We're moving past just the dollar sign to focus on the architecture of the policy itself. We're trying to find that perfect blend of term and permanent coverage that can handle everything from short-term debts to generational tax issues, all while, respecting your cash flow.
It's the difference between calculation and execution, really. And for execution, you need foresight. When we finalize a recommendation, we filter everything through three pillars. First is the duration of the risk. Second, cash flow and maybe some long-term investment goals. And third, you have to drill down into the fine print. I mean, the really non-negotiable stuff like beneficiaries and the core policy mechanics. And to make this all concrete, we're going to use a pretty detailed case study, a client we'll call Derek, who needs about $760,000 in new coverage.
All right, so let's start with duration. We all basically know term is temporary, permanent is forever, but what's the real operational difference? I mean, isn't permanent insurance just a huge bet that you'll die eventually?
It's a bet on how long a financial liability will last. Term insurance is cheap because the insurer knows there's an end date. It's perfect for things like a mortgage or supporting your kids until they're, say, 25 and financially independent, or even just replacing your income until you plan to retire. Eventually, that risk it vanishes.
But isn't there a massive gamble there? If you pick a term policy for a risk that might last, 50 years, you're just kicking the can down the road.
Precisely. And that is exactly where permanent coverage comes in. It's for those indefinite needs, the liabilities that will still be there whether you pass away next year or, 60 years from now.
So what are the clearest examples of a truly permanent risk? I mean, other than just wanting to leave a pile of money to your grandkids.
The big ones are usually structural. So, number one, providing support for a special needs child who may never be financially independent. Two, funding a charitable donation that you want made at death. And the one we see all the time is estate tax liability, especially on an appreciating asset, like a family cottage. That tax bill only shows up when you die, and since the cottage's value is probably going up, the liability itself is constantly growing.
Okay, let's apply this to Derek's situation then. He's got a whole stack of deadlines. His term needs are child support for Jordan, that's 11 years, spousal support up to 21 years, and paying off his mortgage, which has 18 years left.
Right, but those are completely distinct from his two permanent needs. He has a significant tax liability on an inherited cottage, and he's made a personal pledge to leave $100,000 to his local hospice. Those two things, they demand a whole life or a universal life policy to make sure they're covered no matter when he passes.
So beyond risk duration, the sources talk a lot about a client's ability to invest. If I'm already maxing out my RRSP and my TFSA, how does that connect to choosing a permanent life insurance policy?
Well, it gives you a reason to choose a permanent policy with cash value. If you've already filled up all your usual tax-advantaged accounts, something like a whole life or universal life policy becomes another place for tax-deferred savings to grow. It turns into a wealth transfer tool, not just protection. But, that isn't Derek's problem right now. He and his spouse, Becky, aren't maximizing their RRSPs yet, so their decision is purely about essential protection.
And that brings us to the hard reality check. Cash flow. Derek's family only has about $440 a month available for insurance. That is tight. When cash flow is the main constraint, term insurance is often the only real option to start with.
And this is where the planning becomes absolutely critical. We know Derek is constrained today, but he's expecting a promotion in 2 years that should boost his income by about $500 a month. So any term policy he buys now must, and I mean absolutely must, include a conversion option.
Okay, walk us through that. The conversion option, why is getting that right today so valuable, even if he can't afford the permanent premium just yet?
Because it locks in your current health status. Forever. The conversion option lets Derek switch his temporary term policy to a permanent one later on, when he can afford it, without a new medical exam. If he develops, say, a major illness in the next 2 years, that right to convert at his current healthy rating it's priceless. You're securing your insurability now for a premium you can actually pay later.
That makes a ton of sense.
Yeah.
Now, you mentioned whole life and universal life. If his cash flow is better, how would he choose between those two?
Think of it like this. Whole life is sort of a fixed budget. The premiums are fixed, the benefits are guaranteed, the cash value grows predictably. Universal life, or UL, is more like having a buffer account. It gives you flexibility. You can often adjust your premium payments up or down, within certain limits, of course. So for clients with income that, fluctuates a lot, UL can be a much better fit.
All right, let's get into the real finesse here, the math.
Yeah.
Derek needs $760,000 in new coverage. How do we structure that to minimize the cost over the next 20 years? This is that art of layering, right?
Exactly. We define each need and match the policy to its duration. So we'd recommend $200,000 of whole life for the permanent needs, the cottage tax, and the hospice donation. And crucially, we'd recommend using the paid-up additions, or PUA, dividend option.
Wait, hold on. PUA, how does that help with the cottage's increasing value?
It's actually a brilliant bit of engineering. Instead of taking the policy dividends as cash, the PUA option uses them to buy tiny fractional units of additional paid-up permanent insurance every single year.
So the death benefit just automatically grows over time.
Exactly. It helps the death benefit, the money that's there to pay the tax keep pace with the appreciating value of the cottage. It's a self-adjusting solution.
That is a key piece of information. So for the term part, we layer it.
We do. We isolate the shortest term risk. That's $180,000 on a Term 10 policy. It covers Jordan's child support and a car loan. Both will be gone in under 10 years. And then the remaining $380,000 goes into a Term 20 policy for the longer risks, the mortgage, spousal support, that sort of thing.
Okay, so let's look at the actual numbers. The sources compared this layered approach, option C, against a simpler plan, option B, which was just one long T20 policy. What did the math show?
Well, a simple single T20 policy, option B, would have cost Derek a cumulative $67,680 over 20 years. But by being precise and layering using that cheaper T10 for the short-term need, the total cost for option C drops.
By how much?
Option C comes in at $61,850.
Wow, so that's a savings of almost $6,000.
$5,830 over 2 decades just by matching the term length to the risk. That's the kind of subtle saving that makes the difference between affording this whole package or not.
That's just pure efficiency. Now let's shift to the rest of the family. Derek needs $150,000 on his wife, Becky, and $10,000 on each kid. What's the smartest way to do that?
Again, it's about using riders to avoid extra fees. You could buy a standalone policy on Becky plus a child rider, and that would cost about $23.54 a month.
But the better way is
to add a single-family life rider directly onto Derek's new whole life policy. That covers Becky and the children, but the total cost is only $19.04 per month.
because you're not paying a separate policy fee.
Exactly. You bypass the admin fee. It's a small detail, but it's about maximizing every single dollar.
On that note, the sources mention one policy type that is not right for Derek, a joint last-to-die policy. Why wouldn't it work for his estate taxes?
Because the cottage is being held in trust for the children. This means the typical tax-free rollover to a surviving spouse doesn't apply here. The tax liability is triggered the moment Derek dies because the asset doesn't go to Becky. So you absolutely need a single life policy on Derek to cover that immediate tax hit.
Now let's pivot to something really surprising, replacing an existing policy. Derek has this $250,000 Term 10 policy, and the premium was about to skyrocket on renewal, from $250 a year to over $1,000. A huge jump.
A huge jump, and yet despite that, the analysis showed something really stark. Derek was far, far better off just keeping and renewing that old policy.
Wait, so even with that massive price hike, keeping the old expensive policy is still the winning move? How does that even work?
The reason is brutal. He had started smoking again since he first bought that policy years ago. The old policy is locked in at his original non-smoker health rating, but a brand new policy today. It would be priced based on his current status as a smoker.
And what's the financial impact of that one change in his health?
It's staggering. Over the next 20 years, keeping and renewing the old policy costs him a total of $32,750.
Okay.
Buying a new replacement policy today as a smoker would cost him $64,800 over that same period.
It literally doubled the cost.
It doubled his premium liability. It's the ultimate lesson in never ever dropping an old policy until you are 100% sure you can get something better based on your health today.
So after all that, we have the final recommended package. To cover everything, Derek's total premium is $956 a month. But his cash flow is only $440. That's a $516 gap. Every single month. This is where the real trade-offs have to happen.
This is the moment of truth for the family. He has to make some hard choices. He could reduce coverage. Maybe he drops a $100,000 hospice donation, or he reduces the income replacement, which, forces Becky to go back to work sooner.
Or he could use that conversion option we talked about.
Exactly. He could get term insurance for the permanent needs now with that conversion option baked in, and then commit to converting it later after his promotion. And of course, there's a huge incentive now to stop smoking and reapply for a non-smoker rate in a year.
Let's quickly touch on the fine print people always skip. Beneficiaries. What's the key thing to know if your beneficiaries are kids?
You must name a trustee to manage the funds until they're adults. If you just name your estate as the beneficiary, you run two risks. One, the money is subject to probate fees, and two, the payout becomes public record.
And the whole revocable versus irrevocable thing, that's a big deal.
It is. Most designations are revocable, meaning you can change your mind. The big exception is Quebec, where naming a spouse is automatically revocable. Irrevocable is usually only for court orders or, very specific tax strategies.
Okay, what about key clauses that can deny a claim? Exclusions seem obvious.
Very important. And then there's the incontestability period. For the first 2 years, the insurer can void the policy for material mistakes on your application. After 2 years, it's solid, except for, outright fraud.
Then you have the grace period, usually 30 days. If you die during that time, the benefit is still paid, minus the premium you owed.
Right, and that became a real lifeline during the pandemic when a lot of insurers extended it. And finally, reinstatement. This is so important. Look at Barry in the case study. He let his policy lapse. A new policy today would cost him $150 a month based on his current older age. But by reinstating his old policy, he locked back into his original premium of just $35 a month. Reinstating is almost always the better financial move.
So what does this all mean? It means finalizing a life insurance plan is so much more complex than just a single premium quote. It's actuarial foresight.
And the best decision, like we saw with Derek, almost always involves mixing and matching policies, layering a T10 with a T20, using riders. It's never one size fits all. The sensitivity of the premium to your health and the policy structure is it's intense. Being meticulous can save you tens of thousands of dollars.
So given Derek's tight cash flow and that critical need for permanent coverage on the cottage, he has to make a choice. How much non-monetary value do you and he place on that conversion option, the right to get permanent coverage in the future, versus cutting back on essential coverage today to meet that immediate budget? That is the ultimate trade-off you have to consider. Thanks for diving in with us.